Hello, and welcome to another session of Reflections on Investing with the Cornell Capital Group. And today we're going to talk about the relationship between stock prices, the price-earnings multiple, and earnings. Now, by definition, the stock price equals the price-earnings ratio times earnings. That implies that if the stock price is rising, it's either because of growth in the multiple or growth in the earnings. But it matters a lot which it is. You can think of growth in earnings as being real and tangible. The company is now making more money. What makes the multiple grow? Well, there are two things. One is investor expectations of future growth in earnings, not current earnings. And the other is investors willing to bear risk. If they become less risk averse and they accept a lower return on risky assets, that tends to increase the price earnings ratio. So if you like to divide it up from a philosophical point of view, growth in earnings is real and tangible. Growth in price earnings ratios is related to future risk aversion and future growth. So if you see a stock price rising, you might like to know, why did it rise? Because there was real growth in earnings or because there was growth in sentiment and expectations? And let's look at 4 of the major US companies and break it down that way. And let's start with Apple. So if we go to the iPad, and the way this graph works, on the x-axis is the stock price. On the y-axis, on the other x-axis, are the earnings. And this is over time. The price-earnings ratio is fixed to start at the same level of the stock price. So you cannot read the price-earnings ratio off the graph. But here's Apple beginning in January of 2020, just before COVID. And the red line, the blue line is Apple's stock price, that's here. The red line is the price earnings ratio. And this gold line that stair steps up are the earnings. Notice up through pretty much the end of 2020, the rise in Apple's stock price was due entirely to expansion of the multiple. Earnings barely grew at all. And so the multiple increased and that dragged up the stock price. That would be the stock price changing because of expectations of future growth or lower risk aversion. Perhaps a little airy. Then in the second half, beginning in late 2020 and going through to current, the price earnings ratio stops rising. In fact, it comes down. That's here. But Apple's stock price continues up because the earnings, shown here, rose dramatically. I don't know about you, but I feel much more comfortable when a stock price rises because of increased earnings that I can see and feel. See, the company has more customers, selling more products at higher prices. That's good stuff, rather than just expectations of something in the future. After all, real earnings are hard to lose, but expectations of future earnings can change in a moment. So that's Apple. What about some of the other companies? Here's Amazon. Pretty much the same story. In fact, the PE pulls it up not quite as long as Apple, and then Amazon's earnings tend to take off, and they pull the stock price up and keep it up, and therefore the multiple actually declines. That's Amazon. Here's Alphabet or Google. Looks almost like Apple. The initial price run up is all PE. The subsequent price run up is earnings, so that the multiple actually drops. And finally, Facebook. Facebook's different. It never really got the run up due to the multiple. And then when earnings plateaued, the expectations for future growth dropped, pulled the multiple down with it, and that brought down Facebook's stock price significantly. Now, the way I read all this, and I'll just use Apple, go back to Apple and use it as an example. When Apple was rising purely because of expansion of the multiple, it made me, as a potential investor in Apple, nervous. I felt it was rising based on sentiment that could be reversed at the drop of a hat. Later, when the rise was due to actual increase in earnings, I felt a good deal more comfortable with that. And the fact that the multiple actually declined made me think that though I still believe Apple's very fully valued, it's perhaps not massively overvalued. At any rate, you can draw your own conclusions. But graphs like this that break down the performance into the multiple and the earnings performance are a real useful tool in understanding the historical movement in the price of a common stock. This has been Reflections on Investing.